Well, good morning or good afternoon, depending on what side of the country you're on. Welcome to our April 15th Tax Day Industry Update here at McQueen Financial Advisors. I'm excited. I'm Charlie McQueen, President of McQueen Financial Advisors. With me today, I have two incredible people. Craig Cecilia, our Chief Investment Officer and Managing Director of McQueen Financial. Craig oversees our investment portfolios, now into the $9 billion range. As things have grown, we got to update your picture here, or your numbers here, but running our investment portfolio area, which includes our bond investment portfolio management for institutions, also our charitable donation and employee benefit pre-funding accounts. So thank you, Craig, for joining us today. Also, another incredible person here is Heather Shepperly. Heather is responsible for all of our asset liability management activities. She's a Vice President and ALM Director for McQueen Financial. Heather and her great team, they put out lots and lots of highly accurate ALM reports, giving people great information for making good decisions, and also all the related ALM reports. Really neat stuff there, and in this day and age with all the unique things happening in this world, a lot of focus on the interest rate risk components. And keeping all that cash invested by Craig, and Heather's telling us how to invest it. So really great teamwork here. So thank you both for joining me today. Today, as with our normal webinars, if you have any questions, feel free to click the icon. You might have to move your mouse up or down, and you'll have your bar open up, and there's a Q&A spot. Click on that and type in your question. We'll answer them on the fly or at the end, depending on whichever fits best. The webinar today is going to be recorded. It is being recorded. Please reach out to your advisor. Your advisor will happily give you a link to it, so you can see this and also our YouTube channel, which holds all of our webinars. So with that, today we've got a industry update, and we're going to really kick off talking a little bit about the economy and COVID, and then we're going to talk a bit about investments in ALM throughout actually the entire presentation, and talk about what's happening and what we see happening as we go forward for the remainder of the year. So it wouldn't be a webinar today unless we talked about COVID. So we have to talk about COVID-19 for a minute. And as we kick off with COVID-19, I did get information from a friend of mine that works at a local hospital. And the report was positive. Now, many of you have seen some of the news in Michigan. Our numbers are up quite a bit. We're leading the country now, I think second behind Utah or somewhere else. It just popped up above us. But a lot of infections. The good news I'm hearing from friends in the hospital is that if you have been vaccinated, the likelihood of you being in the hospital is very low, and most cases are recovering quicker. Obviously, that's not the case for everyone, but we are seeing some positives from that. Hopefully, we're heading towards the tail end of this. But one of the things is I've been, as those of you that were on our economic update a few months ago, I was very positive, and I shared this slide. The slide back then showed by June of 2021, we were going to 0 infections. And it's amazing what a couple months can do, and the spike up we've seen here has now pushed that off until the end of 2021. So what I'll say is that this graph is not accurate now. It was not accurate 2 months ago, and it probably won't be accurate in another month. But the good news here is we appear to be on what we're seeing as the hopefully the downslope here, but we've definitely seen a lot of infections really kick up here in the last couple months. Arguably, is it because maybe some states like Michigan over lockdown, or there are worse variants today? We don't know the reasons, but definitely something that's keeping our mind on this. Along with it, the daily death numbers, again, were projected in June to go to 0. With masks on, we're now looking at August getting closer to 0. So we're definitely seeing things still getting closer, but this peak up here is causing things to delay a little bit. Hospitalization use, obviously something very, very important. The good news is the hospitals still have room. We have had some start to reduce some elective surgeries a little bit here, but we're still in a good spot when it comes to hospital beds and utilization. So with that, why do we have to talk about COVID? Well, what we really want to focus on is the recovery and where we go with the recovery here. And I'm going to ask Heather and Craig to hop in and give their insights from the asset liability management perspective or the investment advisory perspective throughout the presentation. And as we look forward to a recovery here, One of the things that we are seeing is the K recovery continues. And the good news is most people are in the top half of the K. We'll call that the everyone else bucket. The bottom half of the K, we still are seeing some of those areas really struggle. Now, the worst of the bunch has been conventions and hotels and non-resort areas and some resorts, and transportation has definitely been negatively affected. We're seeing restaurants have either been able to figure out the delivery and make it work, or they haven't. Unfortunately, there's a lot of restaurants that are closing. Obviously, the travel industry has been very, very devastatingly hit here. So we are seeing different outcomes, and a lot of our clients that have membership or in areas with lots of these types of businesses are struggling where others are not. It's not going to be a balanced recovery. We probably are going to see a lot of people traveling or wanting to travel this summer and vacation this summer. So we'll see resort areas of the country probably do quite well. We'll see the hotel utilization good there, but convention centers are definitely going to see some difficult times. Remote work is really causing a dichotomy of a recovery. We're seeing this, that if you're in an industry such as a financial institution, a lot of our activities can be done remotely. Not all. Obviously, teller lines, people need to be on teller lines and to be places to interact with customers or members. But if in the analyst and technology and call center areas, those are really doing quite well. We're seeing people able to go to work, maybe even cost down at work. And so things are working well. And also people are having a bit of free time, which is actually leading to people doing all sorts of winter and summertime activities, which are different than what we've historically seen. The places that are not able to be remote, again, hotels, travel, restaurants, they're definitely struggling. Income has gone to zero. Now, fortunately, there's a lot of government stimulus. There's a lot of extended unemployment benefits. So there's a lot of money coming into people. So we're definitely seeing that people are having dollars to spend. But it is difficult that if you've been in the hotel industry your entire life, there just aren't jobs open, and the ones that are open are probably not where people live. So it's going to be a bit of a relocation process. One of the best things here has been the stock market. Stock market continues to skyrocket, and a lot of this relates back to the stimulus dollars and where the stimulus dollars are going. And we've seen a massive uptick of people investing in the stock market. Our last economic update, I had some charts showing the growth in accounts at Schwab and Robinhood and all sorts of places that have seen massive growth. And just today, CNBC is reporting on surveys that between 6 to 9% of all people receiving government stimulus checks plan on investing those checks. I think it's a bigger number personally, and how the stock market is acting, it appears to be a bigger number. We're up to record levels one more time. All right. From here, housing. Housing is definitely an interesting spot. Housing's having a lot of interesting modifications, both on the asset liability management side of our business and also in the investment advisory business. One of the really interesting charts we have is that the aging in place. I love the term, but we're now showing that 25% of the population has been in their home for more than 20 years. Now that was around 7% 15 years ago. And so what we've seen happen is two unique activities. One was the financial crisis, where we saw people were underwater and didn't leave their houses. And then two, once we've gone through that recovery, we actually saw home prices lower, but then they came back up, so people were not underwater. And then now you add into that a pandemic. At first, moving in a pandemic seemed very scary. Now moving in a pandemic to get an extra room for a home office sounds like a really good idea right now. Or a pool so the kids can be outside so I can be on a conference call, whatever it may be. But we're seeing people look for different things now, and we're going to see this make some differences. And as people stay in homes longer, we're also going to see some value differences and some supply and demand differences, which we'll talk about in a second. But going back to what I said a minute ago, this is where we saw home prices come up, come way down, and then come back up. And now we're substantially higher than we were. If you look at this chart over a long period of time, from 2000 to 2020, we've actually had a reasonable price increase of close to 4.5% to 5% a year over that time frame. It's just that we went up a bunch, came way down, went back up. And so a lot of it seems very spiky, but when you look at home values over a long period of time, they've actually been fairly reasonable. So thinking about that with the housing market, this is where we've seen some interesting things take place. And we'll talk a bit about the ALM impact of this and the investment impact. But if we think about what's happening with home values, we were in a spot back in 2005, 6, 7, 8, where we just had too many homes and there's a lot of speculation in the housing market. From there, we've only built about 400,000 homes a year all the way up until 2020. The problem with that is we have roughly 320 million people in this country, and 1% growth means you need 3.2 million homes, and not everyone's going to be buying a home. So cut that in half and just say 1.5 million homes. So we've gone for a period of time a lack of building of homes. And so today what we're seeing, the price increases are due to needs for more homes, need for different homes when working from home, and people wanting to move and just not enough supply. People are not buying 2 or 3 homes speculatively, they're buying a home to live in. And so it's truly a supply and demand problem at this point. We think over time it will improve. There's also a bit about the cost to build a home, which are a bit higher right now with some supply chain problems, which are also going to be causing things to come up a little bit. So thinking about housing here, maybe Craig, can you give us some insight of how you're seeing this housing market and things impact the interest rate or impact the investment portfolio world?
Sure. It's actually really interesting to think about just simply the housing and what is the tool used for housing to facilitate ownership and transactions is the mortgage. And you look at the supply issue and the value issue. It boils down to in the investment world is what is the performance of these mortgages that are collateralized in investments? And as you look at something you mentioned, Charlie, earlier is why would somebody look to move right now? As there's still a little bit of uncertainty, but there is still that pulling equity out, getting something bigger, better, or something that's more appropriate for maybe a hybrid, if not permanent, working from home situation. So something that's more accommodative. And so trying to predict on how these loans are going to go forward is extremely difficult, but not necessarily as difficult as important. So we've seen a big swing over the last 9 to 12 months of prepayment speeds from being extremely high to softening up where it didn't make sense. And so modeling and trying to do various vectors when thinking about investing in the market, and the mortgage market is one of the biggest markets in the world, is to make sure you're very deliberate with your modeling, and so you can kind of predict cash flows. And when you're getting into, say, CMO modeling, where you can actually have structured structures that actually insulate you from the volatility, is a really good way to be looking at that right now. So the impact has been, people have to sharpen their pencil if they want to make sure they can accurately have a predictable portfolio and still get a reasonable amount of cash flow that they can expect from the market.
Wonderful. It's really interesting. The prepayment speeds are all over the place, and we're probably going to see refinances come down, which that directly affects ALM. Heather, you have some thoughts on that?
Yeah, absolutely. To many of the points that Craig brought up in regards to the housing market and the availability, it has had a very large impact to risk, knowing that rates are very low and that incentive to both refinance and look at these new types of products. We're seeing a lot of funding coming in just from the fee structures on a lot of these loans that are coming in. And loans right now are very difficult to come by. So the housing market is definitely helping offset a little bit of that right now, which has been great. But when it comes to sensitivity, it actually has shown some more favorable shifts when it comes to value. So that it's definitely had some really good impact to a lot of balance sheets, giving us some more flexibility when it comes to looking at alternative ways to make up for some of the losses in loans as we shift more to investments and things of that sort. So that housing has definitely been a benefit on some ends and giving us some more flexibility, which has been great. But there's been a lot of volume of these mortgages coming onto the books, which is definitely beneficial. And then the prepay speeds being so fast, it's really shortened some of that duration. So it's offsetting and giving us a little bit of a cushion when it comes to risk, but everything that we can to try to offset some of those losses when it comes to interest rates.
Yeah, Heather, that's a really good point. And one of the things I'll add here is, this refinance boom that we've been in has been really, really good, and it's propelled so much non-interest income. And now we're probably going to see that dry up, but hopefully the new purchase business stays strong, which usually makes bigger margins, and that'll continue to help some of those earnings for a while. We did have a question come in, and it was, what effect do you see on housing from companies that are advertising to buy your home for cash with a quick closing? And do we see this buying up supply of existing homes, or and potentially turning them into rental properties or different things? And I think that, to me, it's really interesting, and I'll ask both of you to comment on this if you like. I see companies like this popping up as just opportunistic. They know that there's such a good demand, and probably even a bigger demand that I've seen for move-in ready homes, where they're willing to go in and hopefully do a quick close to buy cheap a home and fix it and sell it. And so I look at that as it is going to take up some of the supply, but I think that's just a add-on to what's happening, because of what's happening, that is available to happen.
It's interesting too. It's a really good question, because as we think about the population growth versus homes coming onto the market, as you commented earlier, Charlie, one of the things I also like to think about is the demand for rental properties. And there's, we're going to argue throughout this that, is the economy doing good or is the economy doing bad? Because there's indicators for both directions of the economy. And one of the indicators was when you talked about employment and the economy, the haves and the have-nots, or the K recovery. And so I think for some of that market, the lower of the K, all the others, or in certain industries, there's going to be demand for those rentals. And I think you're right. There's some opportunistic plays for people to buy the cash, looking at the cash flows that they expect from rentals, and say, this is a decent ROI, compared to trying to buy into the equity market at all-time highs that we've never seen before. So I think there is a sort of opportunity that will continue to exist, probably at least for the next few years. So it does kind of make some sense for investors that are looking to do that.
Okay. One thing I will add, it's interesting to think about this. It's cost $1,000 a month to borrow $250,000. And what does it cost to rent an apartment today? And so there's some interesting dichotomy there that shows up between the cost of rent and the cost of owning now.
Well, that also depends, though, is cost of ownership of whether it's forbearance or not, right? No cash flow if you're in forbearance.
Yeah, but as you pointed out to me the other day, it's forbearance is getting a little lower, just to be a little forecasting here, a little foreshadowing.
Oh, gotcha.
Excuse me. Yep. Love it. All right, so let's talk a little bit about employment and what's happening there, and talk about how that affects our world here. This chart was one that really surprised me, and this is the labor force participation rate. And the labor force participation rate has been coming down as we have an aging population in our country. But then a little bit of a downturn also, and you tend to get a little bit more of structural unemployment. But when COVID hit, a lot of people exited the workforce. And I look at this at maybe some of the tail of the baby boomers that were just not retiring, that finally said, forget it, I'm not working in this environment, and retired. But we did see a bit of recovery, people re-entering the workforce. There may be some incentive not to work based off of some of the unemployment payments that are happening now. But definitely an interesting spot with this labor force participation rate, which in a lot of ways may be driving up some wage-based inflation. As we look at the length of unemployment in general, it is to me quite amazing. We were below 5% unemployment a year ago. A little pandemic hits. We spike up to numbers that are non-sustainable, but people just stopped working. No one knew what to do. Upped all in the 23, 24%. And now state of Michigan's back to 5%, United States 6%. And some of the numbers that we're getting out this week on unemployment claims are plummeting. So we do expect the numbers to actually go below 5%, and the Fed is predicting much lower rates. How do you see this affecting ALM, Heather? And then Craig will the same question to you after Heather.
Yeah, this is definitely having an impact to our balance sheet. It's very difficult to find good people right now. And so with that, it's when we do find good alternatives, it's costing us a lot more money. So when we do that, it's definitely starting to squeeze our margins a bit. And with having so much stimulus in the market because of unemployment, it's not really giving that incentive for those people to actually look for work. So it's really making it a big squeeze for us to be able to continue to be profitable and be able to be fully staffed. We're seeing a lot of issues with successorship when it comes to that next generation coming in the door. So that's making it a lot more difficult. We're seeing a lot of institutions as an alternative of looking to merge instead of finding that next person in line, because they're just harder and harder to find. And this environment's making it that much more difficult.
Yeah, and it is adding to some wage inflation there. On the portfolio side, I also think about well, I keep going back to it, but that the improving economy we're seeing, and this chart that you're still on, Charlie, is a really good representation. And if you look at the length of unemployment, how it's improved for so long, but now if we look at, with the programs that the government have in place and the time that people are on unemployment right now continue to grow, and even the unemployment numbers not at full employment yet, they're improving, with the exception of the the negative side of the length of employment, but the numbers are improving drastically. Until we get to some really sustained full employment numbers, though, these numbers are going to continue to cause the Fed to hold their stance and not change interest rates. And as we think about that of investing our liquidity that's in the marketplace, we got to try to predict where interest rates are versus where they will be, and what part of that curve makes the most sense. And with the way that the Fed, and even just most recently, they said we're going to be at some levels for quite some time that are above our target range, and we're probably not going to be moving. That helps us decide where we should be. But it also tells us that the Fed's not going to move for quite some time until we have this employment numbers that really become sustained at some good levels.
Yeah, it's a good point. And I think there's a combination of jobs are not there and people taking additional time with the unemployment benefits. But I always think of the person that works in the convention hall with no convention happening. That unemployment's going to be longer. And so I do think that, as we get closer, hopefully, to the end of COVID or to a sustainable position of management of COVID, that we're going to see a lot of these things greatly improve. And one of the things we'll foreshadow is that maybe some of you have heard me talk about the roaring 2021s and the roaring 2022s. I really believe this second half of this year, we're going to see things really going strong. And this is one of the main reasons behind it is employment there are more job openings today than unemployed people. And that is something to really think about. And that's what really starts you off for a good economic environment. Okay. All right, so I asked you the questions there, so thank you guys. The consumer. Now, our industry is all about the consumer. And thinking about how the consumer is acting and how the consumer is set up is really the most important outcome for us to think about. And the consumer is 70% plus of the economy. And one of the things I'll really kick off here, I'm pretty excited. The lines have all merged and turned into the upward hockey stick at this point. We look at consumer confidence, current conditions were really high coming into this. The economy was at a record level, going extremely strong, and then the coronavirus starts up. And so what that did is that caused confidence to drop, but now overall confidence and 6-month expected confidence did not come down nearly as much. But to me, it's not often we see this number move in unison, and we're really seeing a positive impact to everyone with belief that we're getting towards the end of the time frame here of coronavirus. Now, consumer confidence is important because this drives lending. One of the things that we've seen, and Heather asked you a little bit about, we think about people and money, obviously record levels of cash on ALM reports, and probably you're going to tell me record low loan to deposit ratios, and I know you have a slide here in a minute to foreshadow. One of the things I want to remind people is you don't want to force additional loans on your books today. You want to wait until the consumer wants to spend money and businesses want to spend money and borrow money. Forcing it when people don't want it is always something we ought to think carefully about not doing. With that, one of the most unique things, a couple of you may have seen me talk about this before, I'll always talk about this before, RV sales are skyrocketing, up 20% in 2020. My understanding is they're going to be up more than 20% in 2021. One of the things that I challenge you is find a spot to put your RV during the summer. Everything I can see is campsites are all booked, and all over the country, not just northern Michigan where we all want to be in the summer, but all over the country. As people have bought so many RVs, we need more RV parking spots now. And so one of the things here, I think it's going to be difficult for the consumer to spend as much money as they want this summer, and so we're probably going to see cash balances stay higher. A lot of people expect consumers to go spend all their money. I think they're going to struggle to spend the money. They're going to want to spend the money, but they're not going to be able to get a hotel reservation because they're already booked, or take their RV somewhere. Another component with this is snowshoes. I mentioned earlier on a call today, I was looking for snowshoes this winter, and I couldn't figure out why I couldn't find snowshoes. So I did a little Googling. Snowshoe sales are up 273%. And Craig would say binging, by the way, but I say Googling. But when you start looking and binging this information, people were looking for activities. And so as you lend money, as you see what your members or customers are doing, they're doing outdoor activities, they're doing family-based activities. And so we're going to continue to see the consumer really move in this direction. Related with this, one of the things I really want to encourage everyone to think about is how you serve your customers or members. We had here back a couple weeks ago, Huntington Bank is closing 200 branches, including all their Meijer locations. Now, we're seeing banks close branches, and they've been on this branch closing path since 2009. And this graph got cut off, but it goes to 2021, and it continues down at the same path. When we look at credit unions, for the first time this last year, credit unions actually closed more branches than they've opened. As we think about a pandemic, and one of the things I think is be very important for our industry is really to think about how people are going to work with you. I personally have not been in the branch of one of my financial institutions, personal financial institutions, in over a year. I've used bill pay. I've used bill pay on my cell phone, not on my computer, but on my cell phone. So we're definitely seeing things change. And also, I'm usually a normal user of cash. I think I've been to an ATM about quarterly now. So definitely a lot of changes going on in how people utilize your facilities, and it's something to think about as you go forward. All right, Heather, this is a fun graph for you and a fun graph for Craig. This is making a lot of things change. I think this to me is really one of those stunning graphs. We're going to be giving a presentation on the unintended consequences of government stimulus, and I think I'm going to throw this chart up there and be done. The stimulus packages from the Trump administration and now the Biden administration has caused money supply to grow over 5 years worth of growth in just 1 year. It's actually closer to 7 the more and more I analyze the numbers, and we see the last round of stimulus really coming out. but we're seeing close to 7 years worth of growth of money supply in 1 year. And this is what we're all experiencing: higher deposit balances causing higher cash, so more assets, equity ratios getting squeezed, and then a ton of money getting invested. One of the things I like to ask Craig about, I think he's going to say that it's a good looking yield curve, but one of the things is we look at this, it's not often you can invest and make such a big return. If you'd invest and get a 1.2% yield today, you're actually getting 12 times more than the yield on cash at 10 basis points. Truly an interesting market.
So Charlie, you are right. That is a beautiful graph, and it's going to cause us to just, when we get to the interest rate curve, it's going to be the best yield curve we've seen in a long time. Optimism right there.
Love it. Another graph that shows what's happening to our industry really well is household debt and income. And the blue line shows our debt to income. And during the housing crisis, the overpricing of homes, people loaded up on debt. We see the red line, which is debt skyrocket. But what we've seen happen since then is truly amazing. Household debt to income now is back to the levels that we were in year 2000, if not a little earlier than that. What do we mean by that? People, or Charlie used to have a 7% mortgage. Now I have a 2.4% mortgage. And maybe I haven't moved, so I've been paying down my debt for 15 years, so it's a much lower amount that I've borrowed. And so the result here is that we're actually seeing consumers in one of the best spots they've been with debt payments to income. And this is really putting the consumer in a great spot to come out of this weird environment we're in with lots of ability to spend and lots of ability to take on more debt, which is one of the reasons why I'm calling for all of us to wear our flapper outfits starting in July 1st throughout the entire summer and all of 2021. So it's going to be a lot of fun. Delinquency rates, what's happening? We're seeing actually people paying down credit card loans. Credit card delinquency down to 2%, one of the lowest numbers I've ever seen. Home equity loans are not delinquent. We're seeing student loans drop substantially on delinquency. Auto loans are higher than one would expect, around 4.7%, but that may have a lot to do when relating back to people doing 10-year and 8-9-year car loans and the negative effect of those long-term amortizations on a depreciating asset. So with that, no one's delinquent. We're in a good spot. And Craig, one of the things you pointed out to me the other day is that we're seeing forbearances drop substantially. Is this affecting the investment market for you?
Well, the forbearances numbers that are declining are starting to now be accounted for within, say, prepayment speeds. And so it's becoming more of a true gauge. We're still a long ways away of where we can capture the real speeds that we would like to see. Whenever you have such a increase in forbearance numbers and high as they went, it's going to make some impact there. But comments also is, I really need you to go back a few slides, if that's possible, to the RV slide, Charlie. If you, wow, operator is working great. All right, everybody look at this picture. What's missing here? Everybody's going to give you a different answer of what's missing in this picture. I'll just say one, a cooler. Who doesn't go RVing when they sit in lawn chairs without a cooler, right? I'm not an RV person, but that's just what I think. And the reason I asked that, one, to be a little bit funny, but two is as we look to the investment market, we got to look for these little diamonds that are, where do we look to where there's going to be continued demand, maybe shortage of supplies that are taking place in sectors that you can really invest in that are going to continue to benefit in the new environment we're in right now. And cooler sales are one of them, just like some RVs or snowshoes that you brought up as well. So really using this this market to our advantage when thinking about investing and what to do is extremely important. And then, going forward to that consumer confidence, Charlie, there's also some good information. I apologize if I'm taking up too much time. Just cut me off if I am. But the consumer confidence chart, you'll see that we've got some great numbers, right? Kind of confidence is improving. Still a little bit low than it was, say, in 2017, 2018. But typically when you have high consumer confidence, you have a lot of spending going on. And with our skyrocketing snowshoe sales, that's a great example. It's spending going on. But credit card balances are coming down and people are paying cash. Savings rate is up, which is normally you have a savings rate when consumer confidence is lower. So we do have very mixed signals going on, and a lot of it is driven off of we're in an economy that we've never experienced before. It doesn't matter if you're old like Charlie or young like Heather. No one has seen these types of economies and the governmental support that's taking place. So we do have supply issues as well that's kind of putting towards some inflationary numbers. And ultimately the consumer is helping us move along because they are spending their money that they're coming in, the stimulus that's coming in. And that's important to consider. That's going to help us. We need to maintain that confidence so that we can get right on the right track.
I appreciate the information, the thoughts there, Craig. And Brian did let me know that you don't need a cooler for that kind of camper, that it does have a refrigerator.
Oh, is that right?
But he did notice no kids, and I'm guessing that's why the two of them were smiling. So, all right. And John, the other question, we will be definitely give us a call. We'll get you a copy of the slides there. So thank you for that question. All right. This is an amazing chart. Heather, have at it. It's all yours.
All right. So what you're looking at here is the trend analysis that we tend to focus on when it comes to interest rate risk. We want to look at the movements that happen on our balance sheet over time. And the items that we have focused on this page really give us a big picture of what's gone on in the last year and how this has impacted our balance sheet. So as we see all the deposits coming in from the stimulus packages and from the pandemic, and not seeing that disposable income going out the door as everybody's sitting in their homes, you're seeing a lot of changes to what the balance sheet looks like and how that impacts our ratios. And this page is a prime example of that. And starting right at the top, you can see some of the shifts that have happened when we look at capital or net worth position to our assets and all of these other moving ratios. So when we go from December of 19 to December of 20, you can see that our capital assets ratio has dropped over 100 basis points. And a lot of this has to do with just the volume of deposits coming in the door. As we see these stimulus packages come in and not as much spending, we're seeing more and more deposits coming in the door, but it's harder and harder to get the lending to go hand in hand with it. So as that growth has happened, you see our loans to deposit ratio dropping by over 10%. We have more deposits and significantly less lending. And that in turn is causing the size of our assets to grow. The net worth is taking a hit because interest rates are lower. We're not earning as much money. And the combination of those things is really kind of hurting our capital position. Right now, we're still maintaining at a good place, but a lot of examiners understand this, and that we've seen a few that have actually dropped even below 8% just because of the mass volume that's coming in the door and the difficulty to get that money put to work. So looking at our loans to deposit ratio going from in the 70s down into the 60s, we really need to take that money and move it to other areas. And we're seeing a lot more investing having to go on because of this shift. And we go down to our loan yields because of the overall position of where we are. Those are obviously squeezing. And as you see right down that right-hand side, a lot of downward arrows. And this is just because of the cash position, the low interest rate environment, and the squeezing of our margin. And you can see from one section to the next of how this is all coming together. So we see our loan yields have come down. Our investment yields are obviously squeezing as well, but we're getting some offsetting when it comes to our deposit costs, which is great. So you can see our non-maturity deposits have been essentially almost cut in half. Our term deposit costs have gone down as well, but our volume of those has also gone down because there's not as much demand or need to bring money in the door. We're getting plenty when it comes to the shares and deposits just coming right in. So we're not having to fight for those term deposits as much anymore. And you're seeing that when it comes to the yield opportunities when we look at CD investments. Obviously, there's not a lot of incentive there for those deposits because technically we really don't need them. We're getting enough of that cash. So our overall cost of funds, again, has been cut more than in half, which is offsetting some of that squeeze that we're seeing from the asset side of the balance sheet. And then as we combine all of these moving pieces together with the reduction on the assets, but also a little bit of offsetting on that liability cost, our spread is really squeezing. And when we look at our spread and we look at our margin, we're doing everything we can to try to sustain where we are and try to offset. And you're seeing a little bit more squeeze when it comes to spread versus margin on this page. And a lot of this really has to do with the makeup that we're getting from the fee incomes. A lot of the PPP loans, we've had some great income that's come off of the fee structures on those loans. We've had a great amount of fee structures coming in from the selling of mortgages and all those mortgage originations and refinancing that's been occurring, which has been fantastic. So we know our return on assets is starting to come down just because of this position, but doing everything that we can to try to get that money put to work and not to hesitate to try to wait for rates to increase before we put that cash to work. And as you know, Craig has mentioned many times of the importance of finding those little diamonds and making sure that we're putting our money in the right places here. So what is this overall impact to our risk position? What does this look like when it comes to net interest income? What does this look like when it comes to our NIV? Well, when we look at net interest income, we are looking at that upward movement in this up scenario. So as we look at an up 300, you know, historically we were sitting very, very close to that 0%. But right now we're much more liquid. We have a lot more cash. So we're going to move right with the market as rates start to go up. So you're really seeing this big boost when it comes to net interest income. So that's why you're seeing that large increase. And with that combination of cash and with the combination of the incentive to refinance and these lower interest rates, prepay speeds have come up significantly. That again is shortening the duration of our balance sheet, especially as we put a lot more mortgages on as that demand is so strong right now. So as we have higher prepay speeds, that shortening of the balance sheet, you can see when it comes to our value and our NIV, that's actually become more favorable over time just because of the structure of everything that's happening and how that's coming onto the balance sheet, what that risk looks like, and all these moving pieces that are coming into play because of where we are right now.
You know, Heather, it's really some great insights, and with this group, I mean, thinking about what does this really mean to us, and I love this. And this data, a couple questions came in. What is this data based off of? And this is based off of a grouping of clients of ours all over the country, banks and credit unions combined. So it's a unique group that we have that we follow. And to me, a couple of the main key takeaways on top of what Heather said, which is just great information. Loans are definitely a struggle. It's so hard to keep loans on the books today. It's okay to have a lower loan to deposit ratio. You don't have to go do things. You don't have to buy loans. People are not borrowing money. It's okay to continue at a lower loan to deposit ratio. But with that, I definitely think you need to make sure that we're fully invested. And that's something I know that Craig and his team work really hard, and they're trying hard to keep all the dollars out. And that's really important because every dollar invested is going to make you get 10, 12, 14 times more than cash. Not very often you can talk about that kind of spread. Earnings are definitely getting tighter, especially if you don't have sources of non-interest income, such as gain on sale of mortgages, and what we're going to talk a lot more about here as we go forward, probably, or will in the next years, SBA lending and other government program lending for gains on sale. So really, really great information.
And the nice part as well, Charlie, with this is because our risk has become more favorable, this gives us so much more flexibility to look at these different ways to try to put that money to work and to invest. It gives us lots of great opportunities here with that flexibility.
Yep. A question just came in, and thank you, Rick. With longer term rates increasing in the first quarter and prepayments slowing, how are you seeing net interest income and NIV shifting from year-end results. And what we would expect is that they would be a little bit detrimental. But Heather, go ahead and why don't you take that answer?
So because things have become more favorable and we start to see that shift happen, we are going to see risks start to stabilize a little bit closer to where we were about a year ago or so. Those speeds are starting to adjust a little bit. Rates are starting to come up. We're going to see some benefit when it comes to the asset side of the balance sheet with those higher yields. So that is definitely going to, help our bottom line. It's going to help our spread. But as that shift starts to happen, you're going to see things, we were, as you can see from a year ago, we're a little bit negative. Things got a little bit more favorable. We're going to start to stable back off a little bit. And we're already starting to see a little bit of that shift starting to occur.
So another question that came in, and thank you, Karen, is how much of the interest rate risk and NEV improvement effectively are from non-maturity deposit growth? And that's really an interesting statement. You think about this. We've been bringing in primarily, checking accounts, and then that's where most of the money is going right now. So it's these non-maturity deposits. And we're also seeing CDs decline. So we're seeing risk go, up because of CDs declining, but also earnings improvement from deposit growth in checking accounts. I think it's, what do you think of percentage-wise, Heather? Is it 50-50, shorter loan duration and shorter duration by the non-maturity deposits?
I think it's a really good combination of all of it. I don't think there's, the cash coming in is definitely probably a little bit heavier of an impact than the rest of it, but I think it's probably fairly close to about half and half, maybe 60% worth is really the main makeup of why the shift occurred.
As we wrap up this page, I think what Craig would say, but he's not going to say because I thought of it for him, it's much easier to swim downriver than upriver. And when fishing, you want to float down versus paddle up. And these are the trends that are happening, that are global trends that are going to push your ratios in this direction. You don't want to fight it in a bad way. You want to keep working at getting more loans on the books. You want to keep working and doing the awesome things you do at your organization. But the trend of this deposit growth is so large, you just have to accept a chunk of it and move forward and modify your expectations for your ratios for the next couple of years. Did I put words in your mouth appropriately?
Yeah, well, absolutely you did. I agree with you. One of the questions I did see that came in was, when do we see full employment, kind of a prediction, and we can talk about that now or when we have some interest rates after we go through that. But I'll just shed a little bit of light on our thoughts there on this. When do we see full employment and a 2% inflation target in order to cause the Fed to raise rates? And what is full employment? And in my mind, you're going to get a different number from a lot of people, but in my mind, textbook definition is when you have unemployment with a 4 handle, and we're not that far off. It's just, Charlie had said Michigan's at 5% there, but we do expect to have a full employment like number by year end, and inflation before that above the 2%. But we don't feel that that's going to be the catalyst for the Fed to change interest rates. Their first move, is going to basically take the economy off the stimulus, or lifeline, or crack, if you want to refer to that. But whatever's, helping support the economy right now, it's taking place. It's very material, as we all know. The second, which they'll probably do, they'll have to see that full employment and inflation at a sustained level to cause us to be able to start to wean ourselves off of a couple of things. One is the stimulus, but then they're going to also simultaneously adjust not only interest rates, but adjust their asset purchase program. So that's kind of a necessary thing as well, as they continue to buy billions and billions of dollars. We don't expect that to actually happen anytime until mid-2022, if, when the first step stimulus comes down, the market proves that it can be self-sustaining. We're very skeptical on whether it's going to be self-sustaining. We're going to have a great year this year. A lot of good GDP growth, a lot of great things happening, a lot of expansion, numbers improving. But whether it's sustainable is the question. And so we don't expect any kind of Fed movement for quite some time.
Wonderful. Thank you. It's interesting to me. It's there's a lot of pieces to that puzzle, and there's a lot of levers that the Fed has. And but the important thing I've learned, well, one of the three things I've learned my entire life is that inflation is better than deflation. And so the Fed has said over and over again they're going to be more for inflation than deflation at this point, and that's good for our industry.
We're looking forward to learning about those other two things you've learned, Charlie.
It's going to take a while. Another 5 years, I'll come up with one or two. The 10-year Treasury here, it's been an amazing run in a lot of ways. It's not often I can say that we've effectively tripled the yield from 50 basis points to 160. I love fun with math and small numbers. But we've been on this trend actually going back to the 80s to today, where we hit, in the 20%-ish range, and we've been coming down rather consistently until we've bounced down to 50 basis points. Do you foresee the 10-year Treasury going much higher this year, Craig?
Yes, I do, especially when we get into the second quarter and the third quarter, when we do expect to see some higher inflationary numbers from year over year. They're going to be north of 2. They're going to be north of 3. There's going to be some big numbers there. The markets will react as they always do for kind of looking at the most recent, latest and greatest interest rate that says, hey, this is the new trend. One number may not be a trend in my mind, but markets will. So we might get back up. We went up pretty high. We've trended back down. We'll probably breach a 2% on the 10-year, but not to continue that trend going forward once again, because we'll start to change our stimulus and the economy will soften up a little bit.
And this is going to cause a little bit of bouncing around of interest rate risk. Heather, I can only imagine this is going to change some reports a little bit this coming quarter, as the question was asked earlier.
Oh, absolutely. Lots of shifts and changes are going to start to happen. You're going to start to see some interesting trends start to occur.
Yeah. And then, one may say that refinances may be slowing down just for some strange reason, as 30-year mortgage loans tend to balance off the 10-year Treasury here. So a bit of room in spreads to be made up, but it's definitely going to cause that to slow down. Well, I still think the yield curve's terrible and low yielding, but Craig's going to tell you it's a beautiful yield curve. And Heather can tell you history repeats itself here. We're back to where we were in December of 12, but really, really low short-term rates, which really encourages me to just remember cheap deposit cost is key. Keep your deposit yields as low as possible at this time frame. It's really going to help out the margin, especially with the potential loss of non-interest income. So something for everyone to think about. The spread is coming back into the world, and that goes back to why Craig says it's a nice yield curve, which he is right. It is a nice positive slope yield curve. It's a good shaped yield curve for making money. And we can really see here where we've had the 10-year Treasury bouncing back up, which is going to make us look back kind of how we were coming out of the downturn in 2008-9. Any comments anyone has on the shape of the yield curve here?
Charlie, looking back at the Great Recession, and you look at how that curve changed, it's starting to be like that, right? Right there. And but that was going into a nice time period that we all remember, that low rates for a long time, low and long, right? We're getting to that curve. Now, the next thing is can we get away from that curve? You can see we tried to a few years ago. And but ultimately, what we really want to focus in on is, everybody is going to predict interest rates differently. They're going to go up, they're going to go down, they're going to stay the same. But we want to just manage our balance sheets. And as Heather's group in interest rate risk modeling is so excellent at saying, here's what our risk position is, and here's what happens to our earnings and value if rates change, is we need to continue to focus on that. Look at the spread between, on the right-hand side, the 2 years to the 10-year, or 10-year to Fed funds. You're talking north of 150 basis points. It is just beautiful if you think about it from margins. Would it be better if Fed funds were at 3%? We had, 175 or 200? Absolutely, but we still have a nice shape of yield curve to manage our risk and our interest rate and have a good amount of confidence as long as everything's being modeled correctly. And Heather's group does a fantastic job to say this is what's going to happen. So I love the spread. It's a great environment to really try to manage the interest rate risk and earnings going forward.
And this environment is a different environment than we've been in the past. Obviously, we haven't seen a pandemic since the 20s. But the one thing everyone will remember is the world kept calling that interest rates were going to go up and interest rates were going to go up. And you know, one of the things we did predict, or you predicted correctly, it would be a 10-year problem, and it's been 10. And when this started, we said 5. So there is a few more years probably of low rates. So we need to prepare for that and not be over expecting rates to come up. And as we've already talked about, the Fed's on hold. They're going to be on hold now, but the quick picture of the Fed funds rate. One of the things as we get close to wrapping up here, inflation is a big topic. Inflation is all over the news. Everyone's talking about it. Now, this chart is a couple days old. We did have some higher inflation numbers come out since this was published. Are we concerned about inflation from an investment activity and from an interest rate risk management activity? Are there things that we should be doing differently? I'll throw that out to both of you.
Heather, I'll let you take that first if you like.
So what should we be doing differently going forward, Charlie? That was your question?
Yeah, should we be doing anything differently with the fear of inflation coming forward? And I mean, my premise is I think there's not much we need to worry about except continue to be fully invested and manage our balance sheets given our unique situation, because I don't see much of a modification coming.
Yeah. Well, that's the great part about having that structured ladder on the balance sheet and that constant cash flow. Just because rates aren't where we want now doesn't mean we need to hesitate right now. We need to keep that moving and keep that going. And as time goes on and things start to shift, there's always that cash flow coming in that can be reinvested as that market shifts and moves. So you should never be hesitant. You should never be sitting stagnant and waiting for things to happen. We always have to be moving forward and keeping things moving, not to be afraid of those. But knowing where your risk position is and where those opportunities are is the best way to approach what those decisions need to be. What is the structure of our balance sheet? How does that look? What is the market offering us, and where are those opportunities? So those are the things that we really need to focus on, and then how you move forward using that information you have to make proper decisions.
Wonderful. Thank you. All right. Craig, you let her go first, so I'm skipping you. The results of all this here, and this is a chart that I really wanted to share with people. This is from the FDIC, and this is all banks, and an important component here. Large institutions, the biggest guys in the world, the JP Morgans, are in a 3% or below 3% net interest margin. Community banks and credit unions are at a roughly 3 to 3.5% net interest margin. And what we're going to see happen from this point is we all expect maybe rates are a little higher, a little inflation. We're going to see our margins come up. And effectively what we need to be prepared for is our margins to stay unchanged, even down, because of competition, the amount of cash that's at large banks, the JP Morgans of the world that are going to be really trying to buy more market share to help their earnings out. So we really need to make sure we're paying close attention to our margin. We're keeping our cash fully invested. Why is that? Because we're probably going to be at a low interest rate for a long period of time, and we need every penny working for us. It's not often we can make 12 times more effectively by investing than in cash. Huge difference. And then we look at the risk position. We're definitely in a lower risk position today, given the fact that we have such large growth of deposits and such large growth of cash and a much lower loan to deposit ratio. So with that, Heather, Craig, any parting comments for the group today?
Well, I do think that this is going to be an extremely positive year for the United States. Economically, improving employment. There's going to be pockets of inflation. I don't want anybody to get scared about the pockets of inflation that we're going to see, especially like in the building industry and raw materials and whatnot. It's going to be a good year, but it's going to be not long-lived, and we're going to slow down a little bit. So, but when we have those pockets of inflation where it's going to create, like Heather alluded to earlier, mentioned earlier, it will change asset values. We'll have maybe the 10-year jump up, it's going to devalue assets. It's going to cause a lot of volatility of sensitivity on our balance sheets. Don't panic about it, but make sure you do your due diligence, do your simulations, understand it, document it, and it's going to be a good year, and earnings are going to be good as well.
Thank you, Craig. Heather?
I totally agree with taking advantage of doing some simulations of movements of that balance sheet, understanding, just like we are seeing in a lot of the graphs, lots of spikes, things go this way and that way. There's going to be a lot of stabilizing that's going to happen and occur over the year. So don't be afraid of those movements. Just know over time, as a long term, that is going to stabilize.
Wonderful. Well, first and foremost, I'd like to thank Heather, you, for your insight and time. Really, really valuable. Thank you very much. Craig, also appreciate your insight and time today.
My pleasure.
Thank you, guys.
And we appreciate all of you as clients joining us today and friends. We're here to help. Our goal is long-term success for everyone here on the call. And please reach out to your advisor. We definitely have some unique activities that we have come up with and plans today to keep everyone fully deployed, working on our investment advisory activities, and also working very tightly with our ALM team to ensure that we're investing the funds for the correct time, correct duration to fit your unique needs. So thank you guys very much. We look forward to a wonderful, prosperous 2021 and 2022, and I'm looking forward to wearing some flapper outfits. Everyone have a wonderful day. Thank you.
Thank you, everybody.